Billions of dollars being wiped from share markets around the world. The Japanese market has had its biggest one-day slump in yen terms ever, down more than 12%. The Australian market is down close to 4%. US futures are looking pretty bleak too. So the All Ords and the ASX 200 index closed down around 3.7% each. The losses were spread across the board with every sector in the red. Among the stocks hardest hit, the banks and tech firms. So Block was down more than 10% and CBA down nearly 6%. Across the region, major indices are deep in the red in Asia. NZ50 down around 1.5%. The damage is worse in Japan, with the Nikkei tumbling 12.4%, its biggest single-day percentage rout since Black Monday in October of 1987. And the Australian dollar is buying 64.1 US cents. And independent economist Besa Deda joins us now. Besa, g'day. What is going on?
Well, there's a lot going on. And I guess one of the big triggers, Joe, was really that payrolls or net employment growth in the United States on Friday really disappointed market expectations. And we saw the unemployment rate tick up from 4.1 to 4.3%. And so the market went into a bit of a panic that perhaps the US would fall into recession, and they've really shortened their bets on US rate cuts. In fact, many analysts now expecting that perhaps the US Federal Reserve will need to do 0.5% in September, not 0.25%. Now, usually rate cut expectations do buoy short share markets. But on this occasion, share markets had been quite frothy, number one. And number two, markets are concerned that perhaps the US Federal Reserve has left a little bit late to start cutting rates and therefore won't be enough to avoid a recession.
Why does a 0.2% increase beyond expectations in the unemployment rate in the US have such broad ramifications?
I think because it, one, sends a bit of a signal that US economic activity might be softening a bit faster than anticipated. I don't think there is a lot to panic in terms of the US economy.
Yeah.
I think the US Federal Reserve has quite a bit of firepower available to it if it wants to start cutting and starting aggressively. But it also came on the back of a number of other factors. We've got a rise in geopolitical risk during the week from the Middle East. The Bank of Japan raised rates last week, and that saw a bit of an unwinding of carry trades. Global funds have de-risked. And also, tech shares in the US underwhelmed in terms of earnings. And so, in fact, the US NASDAQ now is off by more than 10% from its peak in July, which suggests you're in correction territory. And then the volatility index, the VIX index, which is a measure of investors' appetite for risk, spiked to its high since March of last year, which coincided with the US regional banking crisis last year.
And why is Japan being hit so hard?
Well, I think one of the reasons is they hiked rates last week, and they also pointed to the fact that they're likely to, or markets have interpreted rather, their press conference and their statement that they will hike again in October. And so you've got higher rates in Japan, and you've also got...
But they're coming off zero, aren't they?
Yes, it's the second rate hike from very low levels, but also the yen, the Japanese yen, has strengthened quite considerably. So just a few months ago, it was above 160 in terms of the dollar-yen cross, and now it's sitting at about 144. So you've seen a really sharp strengthening in the Japanese yen, you've seen higher rates in the Japanese yen, and so that's really caused a shift in positioning of global funds, and it's also caused a de-risking.
So does it look like things are going to get worse over coming days or not?
Well, I think there is potential for further selling in US share markets and further demand for government bonds, given the evolving situation. But I expect to see some consolidation emerge in the short term. I don't think there's reason for panic. I think certainly the direction of markets is the right direction. We are seeing a softening in US economic activity, but is the magnitude the right magnitude. I think that remains very questionable because I think the size of the magnitude is very big, and I don't think there's reason for panic, even though we've seen these very big moves on Friday night and
when
today.
you say you're expecting some consolidation for the layperson, that means people are going to start getting back into the market and buying.
Yes, after a time of sharp sell-offs, sometimes people can see opportunities in these moves. But I think the risk in the short term is that there's a further sell-off in share markets, given what futures are pointing to.
And what about locally here in Australia? What's happening in the next couple of days?
Well, the big one, Joe, is tomorrow the Reserve Bank board meets. Last time they discussed a rate hike or leaving rates on hold. This time it'll be interesting to see whether they start to contemplate a possible rate cut. Certainly I think the next move is a rate cut, and the threshold for another rate hike is very high. I don't think it'll come tomorrow, so I don't think tomorrow is a live meeting, and that means I don't think they'll be changing the cash rate. But really what the market will be looking for in the accompanying media statement, in the press conference from Michelle Bullock, and also the quarterly statement on monetary policy where you'll get a fresh update on the Reserve Bank's forecast, is the timing of a rate cut. Now, because of what's happened in global financial markets and the risk aversion that's risen and the volatility, what we have seen is that financial markets have now brought forward the possibility of a rate cut to later this year in Australia, where that was sitting early next year before the US data, and also before the Australian inflation report that was published recently.
Yeah, but you're not expecting any move tomorrow?
No, I think tomorrow they're on the sidelines, but we'll be looking to see what the language is, what the forecast suggests, and whether a rate relief will come as soon as November or December.